Chris, let's go ahead and share the screen for the opening slide, if you wouldn't mind. Perfect. I'm going to go ahead and get started here while Lisa works on some of the logistics, but we're 5 minutes past 6 o'clock, so I want to be mindful of everybody's time. Good evening. I am Chandler Hogue. I co-chair the Young Leaders Group for ULI Los Angeles. My day job, I work for Jindal USA. We're a multinational real estate development company where I focus on our investments and capital markets on our ground up US portfolio. Super exciting to introduce the event this evening, Blockchain and CRE, Pioneering a Digital World. And if any of you guys are keeping up with current events, this couldn't be a more timely event. So very excited to have our speakers discuss these topics with you all and talk about what's in this changing landscape. We can go to the next slide, Chris. Before we jump into everything, a couple quick announcements and some huge thank yous, and then I'll turn it over to our panelists. Upcoming events at ULI, you can visit la.uli.org/events. We've got a number of events coming up through the end of the year. Really phenomenal stuff. We're planning for 2022, so please go to our website and check it out. Next slide, please. Member engagement. If you are interested in putting on really cool programs like this or just networking with like-minded career professionals, if you're not currently a ULI member, please think about signing up. And there's multiple ways that you can get involved within the organization. Next slide, please. I'm going to talk really slow on this. You can digest these facts and figures, and we'll go to the next slide. And I want to thank you to all of the annual sponsors. Without your fiscal and monetary commitment, we could not make this possible. So thank you so much for the contribution to ULI and ULI Los Angeles. As a couple quick young leader updates, if you are under the age of 35, you're automatically a young leader. We've got a couple really awesome things coming up, including our 2022 Partnership Forum, which I'm going to put the link to in the chat. Partnership Forum is a year-long mentorship program. You're paired with one senior person in real estate with a group of 10 to 12 mentees. It's a phenomenal opportunity. Please click the link in the chat. If you want to find other ways to get involved with the Young Leaders Group, you can reach out to our communications team via the email that I included in the chat. They'll happily set you up with all of our monthly newsletters and upcoming events. We'll go to the next slide, please. Quick note on the structure, and then I'll hand it off to the panel. We will be going through to 7:30 p.m. this evening. At 7:15, we'll kind of open up to a general audience Q&A. If you do have questions through the course of the event, please put them in the chat box. We'll get through as many of them as we possibly can, but I anticipate it being a pretty high-profile, well-received event, so we might not be able to get through everything. With that, I'm going to turn it over to Murray McQueen, our moderator for the evening, and let the event begin from here. Thank you all.
Thanks, Chandler. Hi, everybody. Thanks for joining. Now, this is great. So my name is Murray McQueen. I'm your moderator. I've been a YLG Partnership Forum mentor for 5 years or so, and I get a lot out of it because I learn so many new ideas from the young people. And so when they asked me to do this, I said, I really don't know much about blockchain. So it should make it interesting. And my mom always said the only stupid question is the one you don't ask. So I may be asking some really simplistic questions, and I hope if people are unclear about things, they ask those questions in the chat room. So Ed?
Hi, I'm Ed Nwakani. I'm the CEO and founder of Red Swan CRE. And I want to thank ULI Los Angeles for inviting me. I think this is a great way to highlight the industry. We definitely are trying to increase our level of adoption throughout the industry. And this is a great program to do that. So thank you very much.
Janine? Or she's coming back on later. Sorry. Yael, I'm sorry. Yael, can you introduce yourself?
Hi guys, I'm Yael Tamar, CEO and co-founder of SolidBlock. we're working on a few great projects in commercial real estate. And I guess the most exciting thing for us is to be able to, talk to the market about, all the new things that are coming into the blockchain space, which is actually on a daily basis. You have new technologies and interesting things. And apparently, and I thank you guys for inviting me, because apparently I'm no longer eligible to be a young leader, according to what you just mentioned.
We will still have you if you want to join us.
Jake.
Yep. Hi guys. My name's Jake Goldstein. I've been very active in ULI YLG for about 3 years now, which is probably why I'm on this panel. I'm currently a broker at Red Swan, and then I have various projects in the metaverse. So kind of all over the place, but it kind of fits this stuff perfectly. So I'm excited to be here.
Well, you're a good person to start us off, because blockchain, crypto, what is all this stuff? Give us a primer.
We'll find out. So first slide, kind of, kicking off this event. This is not a conversation about Bitcoin. It's a conversation about new technologies in real estate. This event will essentially be focusing on blockchain technology and its application to real estate. Next slide. $20 billion. That's the amount of revenue blockchain technology is projected to produce by 2024. The 2021 number is actually only 7 billion. So we're expected to see some explosive growth over the next decade. Next slide. Crypto speak. So here are just some basic terms that we're going to be going over throughout the presentation. So kind of just wanted to present these, right now, just to keep your brains moving. As far as what these terms mean and how it's going to apply to the presentation. Next slide. So what is blockchain? Explaining it very, very high level, not very technical, but it should, hopefully give a, theoretical overview of what it essentially is. So think of blockchain as just a book of transactions. Transactions are written on blocks, just like lines on an Excel spreadsheet. Then these blocks are strung together to make the chain. This is why it is called a blockchain. Blocks full of transactions are strung together to make the chain. A blockchain is literally just a database of transactions. It's just a way to record transactions, high level. Next slide. So how are transactions authenticated? So computers, these are called nodes, work together to authenticate all of these transactions. So all nodes need to verify all the transactions for the transaction to go through. There's no single source of verification. All computers verify all transactions. That's like a very fundamental, important part of blockchain. So this is why blockchain is considered decentralized. There is no single source of verification. All the computers need to verify all transactions. Next slide. Here, so kind of, comparing Bitcoin and Ethereum. Bitcoin is only a currency, where Ethereum, you can think of Ethereum as an app store. Think of Bitcoin as a simple calculator, but Ethereum as a smart calculator. Applications, financial institutions, NFTs can all be built on Ethereum. It's its own ecosystem. Apple's iOS system is to applications, as Ethereum is to dApps, decentralized applications. Next slide. So cryptocurrencies and NFTs. So think of a cryptocurrency as a stock. When you buy ETH, you are essentially buying the Ethereum stock. When the public perception of Ethereum goes up or down, so does the crypto, similar to a stock. NFTs. So think of an NFT as just a digital item with verifiable ownership. It's basically just anything on the internet that has a person's name attached to it. An NFT is much more than just a JPEG. And an NFT is more than just a CryptoPunk or a Bored Ape. They can be, an NFT can be a concert ticket. It could be a game character. It could be virtual land. It could be a Pokemon card. An NFT can really be anything someone owns online. Next slide. Okay, final slide from me, DeFi versus CeFi. So DeFi is short for decentralized finance and CeFi is short for centralized finance. So for example, in CeFi, centralized finance, in order to transact, there needs to be an intermediary like a bank. In DeFi and decentralized finance, there is no intermediary. All transactions happen peer-to-peer without a middleman like a bank. The whole significance of DeFi and the decentralized finance movement is that it's essentially going to take out the need for a middleman in the financial system. Next slide. Perfect.
Unmuting here. Sorry.
All good.
Thank you. That's helpful. My old CFO, who was not a real estate person, always used to tell me, like, Murray, explain it to me as if I'm 5 years old. And so I think, keeping it really simple and stuff like that is very helpful for some of us. But a few questions. So you say all computers need to verify. What's all? What is the all in computers? Is it a subset of every computer that's involved in blockchain, or what is that?
Yeah, so very, very high level, and obviously, all the other panels kind of, chime in here. So essentially, that's so for example, in Ethereum, in order to prove that a transaction is correct, you need to run essentially like very complex algorithms, and you have thousands, tens of thousands. You have tons of computers running these algorithms at the same time just to verify transactions, and all those computers essentially create the network.
So they're all independent computers around the world generally.
Correct. Yes, but they all work together to create the ecosystem that is Ethereum or blockchain.
Okay. So, I guess people say, how do you trust technology? What gives people confidence that this particular mousetrap is, a better mousetrap, as it were?
Yeah. So there's something called smart contracts, which are essentially what it is. It's a contract that has certain qualifications that, when this thing gets met and this thing gets met, then the transaction happens. So that's kind of how it works, right? It's like if this thing happens, this result happens. And those are all written in code in Solidity, which is Ethereum's programming language. You can essentially have any coder create smart contracts that know the Ethereum language to create these contracts that then kind of verify and transact and make sure that the transactions that are happening are verifiable.
Okay. And so, what kind of barriers to entry are there? I know it takes a lot of mass computer power to create, one of these things, but what are some of the other barriers to entry?
Yeah, so in my opinion, the biggest barrier to entry right now is the on-ramp onto Web3. So for example, it's very complicated to kind of, create, to buy Ethereum, kind of create your own wallet, find like the Uniswaps and the Binances to, buy all these coins, buy all these tokens. It's not easy to access Web3, and it's not easy unless you just go on Coinbase or, one of these centralized companies. It's not very easy to kind of get entrenched in the Web3 ecosystem. So I think kind of, when accessing Ethereum is as easy as kind of opening up a web browser, that's when we'll have mass adoption. When it's as easy as butter to use, whereas now it's extremely clunky, it's extremely hard to use. You either need to do tons of research or kind of have someone walk you through it.
I remember that's good. That's good. I remember when the internet first started, we literally had to enter strings of DOS, programming language to get at it. So I get it. So one of the questions from the crowd, is Ethereum the only blockchain used for smart contracts?
No. So essentially, my understanding of it is that all blockchains use some sort of smart contracts. The only difference is the programming language that they use. So if you wanted to create a smart contract in Ethereum, that's Solidity. But if you wanted to create a smart contract on another blockchain like Solana, that's Rust. So
okay. All right. So there's different banks, basically.
Yeah, it's smart contracts, but different, computer sciencey stuff. It's different language.
So here's a kind of a basic question. I remember when blockchain was getting popular a few years ago, people like cryptocurrency, people understood it, but like some of the banks where it was getting stored were getting hacked. And what's changed? How do people feel comfortable? Where do you keep your cryptocurrency, and where do how do you feel comfortable about where it's at?
Yeah, no. Good question. One that I will answer very high level because I don't understand the technical ins and outs of it. But essentially what my understanding of it is that all these blockchains are decentralized, right? Like not one single computer is in charge of kind of housing and storing and kind of verifying all these transactions. So for you to kind of like hack the Ethereum network, you would need to almost hack every single computer. And if 1, 2, 3, 4 computers get hacked, then the network kind of figures that out and adjusts, versus a bank like Bank of America. If Bank of America gets hacked, Bank of America gets hacked, right? The whole system gets hacked. So blockchain in itself, since it's decentralized, is safer. But the best way to keep your Ethereum, your Ethereum safe is like, so for example, if you kind of create a MetaMask wallet, so that's like a browser extension where you can, keep all of your Ethereum, all your cryptocurrencies, you have a seed phrase, and that seed phrase is how you get into your wallet. So keep that seed phrase, don't tell it to anyone, don't lose it, write it down, give it to your mom, give it to your dad, that's kind of like your ticket to your wallet. So that's kind of like, I would be more personally, I'm more scared about losing my seed phrase than I am like someone, hacking my wallet. But I'm just, that's just me. So
that's your double secret password. Okay.
Exactly.
Okay. No, that's helpful. That's helpful. So
yeah,
we're gonna have a lot more questions at the end. So let's move on to Yael if we can. And please go ahead and educate us.
Okay. Happy to. Do I have a presentation or what do I have?
There you are.
Yeah. All right, cool. All right, great meeting everybody. And, I'm here to give you a practical window into what this blockchain technology can do for the real estate space, specifically addressing real estate investing, because there's lots of things actually within real estate that blockchain can do. And please move the slides. Okay, awesome. So this early project that we were privileged to be involved with was the St. Regis Aspen Ski Resort tokenization, Aspen Coin, which was probably the first commercial real estate project in the world. And it at the time, it was raising $18 million. And initially, they were looking at an IPO structure. Part of the reason was because some of the early investors wanted to exit early. One of the biggest problems in real estate is lack of liquidity. When an investor comes into a project, they will expect generally to stay with that project for 5 to 7 years. Now, sometimes there's some ways for investors to exit by speaking to the sponsor, but in general, they're expected to stay, right? So in this specific project, an IPO early on was considered. Because of the costs of the IPO, those plans were scrapped, and the owners, Elevated Return, the issuer of the Aspen Coin, they actually knew about the STO, then this new trend coming onto the market. They were looking for a tech provider at the time, and they found SolidBlock. And that was in basically mid 2018. As I mentioned, the capital required was 18 million, which was about 19% of the equity in the project. There was also a mortgage on the property with JP Morgan. And they were comfortable with up to 20% of the equity tokenized, so hence this weird number, 1914. In Q4 2018, the smart contract and all of the underlying regulatory requirements and compliance were completed, and as well as the fundraise, which actually, do I have more slides? I don't know if I should keep talking. Actually, yeah, okay, great. So yeah, so this property was, you know, as iconic as it gets. A lot of people know it. Most people who ski know this property. As I mentioned, there was a mortgage on the property, and the appraisal value at the time was 224 million. And so how did the team, which was actually a really big team of professionals, execute this project? So the project included a lot of lawyers, okay, a lot of lawyers, because every tokenization starts with the legal component, right? So at the end of the day, this is a traditional security offering with a digital component, right? So traditional security offering requires a private placement memorandum, requires a Form D submitted to the SEC website. And also, so basically what was done here was the Reg D 506C offering. So there were a few law firms involved. They did their part. Then SolidBlock did our part. We created the smart contract, which was on an Ethereum standard, ERC20 standard. And that smart contract essentially, as Jake explained, shows the ownership of that security, right? When investors came into the offering, they came through a landing page, which basically had all the, you know, outline and unique bits of the offering. They could download, you know, the PPM, they could view all the data. At that point, they had to undergo KYC and AML, know your customer, and anti-money laundering. And basically they had to fill in a questionnaire, and as well as accreditation. So they had to show that they are accredited investors in accordance with the Reg D 506C requirements. And then they were able to transfer the funds to whatever bank account specified. And you know, that was the initial process on the day of their investment. When the investment was completed, when the full 18 million was gathered, then the investors actually got the tokens essentially into their wallets, right? It's important to mention that the wallets generally, so as Jake explained, they could be held by individuals. So these are, you know, kind of more decentralized type of wallets. They you know, provided by you know, one of the blockchains, but also you could have wallets that are provided you know, by some of the institutions or you know, companies that are more user friendly. So you can actually have you know, they're in charge of your password. You know, if you lose it, you can actually recover it. So those types of solutions are more frequently used by the industry, just to make a user experience better for the users, right? So this is the type of the solution that we use, and that's where the tokens were distributed. Can you move to the next slide? Okay, fantastic. So then I should have mentioned that at the end, you know, Reg D 506C has a lockup period of 1 year. So, you know, whether or not the offering is digital, the investors usually can't trade their tokens for about 1 year. Well, there's some exceptions applied in various cases. You can shorten that to about 6 months. But in general, for this offering, it took 18 months to list it on an exchange, and now it's trading successfully. It started trading actually at a 28% premium, meaning that it was issued at $1 per share. So $18 million is essentially 18 million shares. 18 million digital securities. And when it was listed on an exchange, it was listed at $1.28. So let's review quickly what are the differences between a traditional and tokenized offering, because, you know, Reg D 506Cs are done, you know, they have been done for some time, essentially from year 2012, when the Jobs Act was passed. That was the act passed by the government to help SMEs, essentially, you know, smaller real estate companies to raise money, so to raise funding, so that the investors are more incentivized, right? That they can put money in and they can take it out before 5 or 7 years, which is generally the cycle of a real estate product, right? So in a traditional offering, you know, if the issue was to do it in a traditional offering, they would just issue some sort of a PDF file, or maybe put the investor in sort of a database online, and that's where their name would be written after they put the funding in, right? So that does not allow anybody to trade their securities easily, as well as, you know, it raises a lot of questions. You know, do I really own this security? How can I prove that I really bought it? It was really me, right? So there are higher admin costs in general, in a non-blockchain environment. There's definitely a high liquidity risk because you cannot sell easily the security, right? So especially, you know, what happened with Aspen Coin was really interesting. If you look at the historical data on the pricing, and 2019 was a really good year for them. Late 2018 and 2019 was a really good year. And it led to dividends being paid out that was actually higher than projected. So, you know, the 4.7 actually became 6.2%. And the Aspen Coin went, you know, it went up in value, right? It was around 30% premium, then even higher, went to 34, and then COVID hit, right? So that, you know, their annual report or their quarterly reports were not as good, right? So then the Aspen Coin dropped to $1, right? Earlier this year, it went back to $1, maybe even 99 cents, at which point a lot of people started buying it. So, you know, also again, as Jake mentioned, a lot of these products, you know, behave similar to stocks. There is a big difference between Bitcoin and the Ethereum and other crypto that is really based on kind of the trust of the individuals into the system. Real estate and security tokens are different. They are usually the value of the token is tied pretty heavily to the underlying asset. So we're not going to see a huge disconnect of the price from the actual value of the asset, which is continuously being appraised, right? So as you saw during the pandemic, you know, a lot of people, the price of the stock went down, and kind of the market did its thing, right? Which would not be an option had this not been tokenized. Right. So, and of course, there's a higher liquidity cost, right? So if you do want to sell, you have the option to go to either a broker or to the company, the sponsor, and so on, and exit, but then you're going to have to pay penalties. There is a question here about whether all the 18 million shares were purchased by one entity. And the answer is that they were purchased by 22 entities in the investment sizes that ranged from $10,000 to over $2 million, right? Which the higher ticket was bought by a fund. And these investors were mainly from the US, and then there were some from Hong Kong and other places in Asia, through what's called a Regulation S, which lets you market your security to individuals outside of the US. And so these 22, actually, once it was issued, were quickly rose to 200. Sorry, once it was listed on an exchange, quickly rose to 200, and now there's over 1,000. And yes, tokenization essentially is syndication with a digital component, meaning we write the ownership on the blockchain so that we can trade, right? So in reality, the tokens replace paper certificates. You have this ledger. If you were using a public blockchain, right, there's public and then there's permission blockchains. In the public blockchain, you actually are able to see all of the transactions online, right? So we have on Ethereum, we have a website called EtherScan, right? And there you can see all of the transactions that this security has undergone, which is fantastic for transparency. You can see how popular a security will be, right? So on the so accredited, as far as accredited investor versus non-accredited, in this specific example, Reg D 506C was used, which is the majority of the securities that are issued today. And that's for accredited investors at this stage of issuance, right? Then on the secondary market, depending on the licenses that the exchange will have, retail investors may have access to the security. There are other types of regulations, Reg A+, for example. Now, in a few new, a lot of platforms are using Reg A+, which is a regulation that is a little bit more complicated. It takes time to apply, actually in this case, you have to get an approval by the SEC as opposed to Reg D 506C, where you just notify the SEC. And in the Reg A+, you can actually raise up to $75 million from retail investors. You can also use Reg CF, crowdfunding regulation, where you can raise up to $5 million from retail investors, again, without any specific approvals from the SEC through a licensed platform. So secondary trading. So Aspen Coin was listed in August 2020 on T0. T0, actually the smart contract was rewritten for the Tezos blockchain. So they're now using that blockchain instead of Ethereum blockchain standard. And so T0 is an automated trading system with a license to trade security tokens or digital securities. And as I mentioned initially, it rose as much as 30%. So we actually believe that just by virtue of an asset becoming liquid, it's going to be valued higher because there will be a higher demand and higher access to that security. In terms of secondary trading, obviously it provides investors a lot of benefits, most of which I already mentioned. Is that it, or do I have anything else, guys?
No, I think that's great. I think we're going to.
Awesome. Very curious.
I have a bunch of questions. Sorry, I have a bunch of questions for you, but we're going to try and keep on track here. So haven't forgotten you. I'll come back at the end because I think it's fascinating and very similar to like REITs came out, and then, REITs often trade above the fair market value of their assets or below, but we can talk about that shortly. Ed?
There's one last quick question. It says, what happens if the property needs capital? Well, in fact, that was the case here as well. Part of the funding went to renovation, and it's just going to become a value add, right? And will raise the price of the security. Okay,
right.
Go ahead.
Okay, no, thank you so much. That's really fascinating. Ed, can you take it from here?
Yeah, hi. It's really nice that I'm coming after Yael because, it was her company, SolidBlock, that kind of helped me make a decision to get into the blockchain industry. I founded Red Swan CRE, which is a marketplace for digitized assets, leveraging the blockchain as well as capital markets, because we saw a significant pain point in the industry. Prior to Red Swan, I was the executive director for Cushman & Wakefield, where I had a lot of transactions for basically 18 years, being an advisor in the capital markets area, in which we've done billions of transactions for customers who were mostly large building owners for apartments and office buildings. And I realized there's a pain point in the industry that needed to be solved. And like Yael had mentioned, liquidity is a big pain point in the industry, but I found that the reason why it wasn't a major problem up until now is because real estate is more of an industry, at least commercial real estate is more of an industry for the elite, people who have a lot of capital, and so liquidity is really not a problem for people who have access to a lot of money. But as you look at the situation now, you find that people need more liquidity so that they can actually generate and buy more assets. But I also felt that the biggest pain point on top of liquidity was access and affordability. And so when we founded Red Swan, it was basically to make sure that we could fractionalize the ownership of commercial real estate and make it more affordable for average accredited investors to buy pieces of real estate and ride on the shoulders of some of the larger organizations and corporations that own a majority of real estate. So that was really the core reason for jumping in. Next slide. So basically, this is partners that we have. I mean, every company that I founded always is centered around a lot of strength between companies that are there to support you, companies that have technology. I was not a technology person per se. I was more of a real estate professional. And so leaning on companies like Polymath, Coinbase, Microsoft gave me a lot of education in terms of the technology we needed to put together to build a platform that actually services the needs of our customers. Next slide. I think we talked about the solutions, but I think, liquidity is one, but you think about real estate in general, it's roughly commercial real estate is $32 trillion worth of asset value. And you can probably estimate that about 35% of that is locked as equity. So you have a lot of equity trapped in real estate for a long period of time. And we felt that was kind of a wasted capital. If you can pull that equity out and still continue to be owner or GP of a piece of property, you now have fresh capital to acquire other assets and grow your assets with the management. So a key component of the liquidity is to provide shareholders or property owners not the ability to just sell out their properties 100%, but to be able to recapitalize their assets and pull fresh equity out while still maintaining maybe a 10% or 20% GP position. So they still can have their traditional earnout for the property, but they're earning out instead of selling, they're earning out through increasing the value of the asset and increasing the dividends of the asset. So we tell our sponsors that they can pretty much pull out a lot of capital of their asset, but still be able to have a kind of a hurdle rate for dividends. And once they pass that hurdle rate for dividends, they now have that kind of GP LP split that you would normally see on a traditional real estate transaction. So typically people would sell the asset in order to generate that earnout. But we think that this is a much more economical and feasible process is to pull your equity out of the asset, still maintain skin in the game, but receive your benefits through the earnout over time. Also, with regards to the LP investors, a big pain point for them is to stay in the asset for 3, 5, 10 years. You never know what the exit date is going to be. Everybody always can estimate an exit time period by saying that this is going to be a 5-year turnaround or a 3-year turnaround. But when it's time to sell, it depends on what the market conditions are if you're able to sell that asset. And so that's a problem for a lot of limited investors. And I think it also restricts a lot of investors from entering the real estate industry because they frankly don't want to tie their money up for a long period of time. And also the cost to come in is very expensive. When I was in brokerage business, most of these transactions that we sold, and I'm talking about the Class A institutional type projects that you see in Main Street around major markets around the country. These are, assets are selling for $50, $100, even $200 million. And so the equity check is $40, $50 million of equity. Very difficult for average accredited investors to be able to participate in that, and they're not invited to the table. So I always felt that it was, very challenging when I'm selling, $40, $50 million piece of real estate, and I'm calling on investors who want to buy into this real estate, but the only ones that can really write that kind of a check were your big companies like Starwood or KKR, and many thousands of investors who had $500,000, $1 million in their bank account would not be invited to the table. So I thought that was unfair for many of the investors who wanted to get into the high quality real estate. And so that's why, creating Red Swan to provide this kind of access, direct access to these quality deals, as well as making them more affordable, was really helping to solve a significant solution in the industry. Also, the benefits in terms of, we've already talked about through Jake, and I'm really proud of Jake that he has so much knowledge about the industry. I have to put him on more of our conference calls with our clients. But, the pain points are there, but I think the benefits in terms of, security, transparency is also extremely important. And I think the blockchain solves that. But I think the two major points that we're really trying to solve, and the problems we're trying to solve, is actually give liquidity to owners so they can pull capital out and still continue to own the benefit of that property. Because if you think about it, it takes a long time to find a good property, right? And in most cases, you're going to take that property and stabilize it so it's generating good revenue. And then all of a sudden, your 3-year, 5-year mark is here, and your investors are forcing you to sell the property because they want to get their capital back. They want to get their profits. So you're selling a property quickly, and then you realize 10 years, 15 years down the road, that property has continued to increase in value, sometimes 200-300%. So if you didn't have to sell the property, you find that there's a lot more value you can pull out of it through tokenization. And this is what we're telling our clients. Next slide. We talked to a lot of business owners who own buildings, mostly multifamily and office. And really, like I said before, they're looking at a time horizon where they can get into the asset, stabilize the asset, and then exit with a profit. And where they really make their money is the earn out. So if you kind of look at this slide here, we're just showing you that if your target to sell the asset is for $500 million, for example, is to make profit of $175 million, that's your profit you're going to make. And then from that, you have to now pay off your financial institution, who's a lender, and you're also some of your debt, secondary debt providers, as well as pay back your equity providers and also pay the profit on top of that. You see that that's $75 million, and you compare it to if you tokenize the asset and you pull out 90%, you can actually see that you have more long-term gain by holding the asset, but even your short-term gain is very similar to what you were going to sell it for in the first place. So we convince a lot of property owners that this is a better scenario for them long-term, is to tokenize their asset and be able to pull equity out. And now it creates a asset management fee because they're managing the asset for the investors, as well as they have remaining LP interests, as Yael has said, will continue to grow over time. And if they now want to start trading in their LP interests of 10%, that's just another value add that they have on top of the GP ownership of that asset. So there's a lot of benefits to tokenization of properties that I think property owners are starting to realize. And I'm going to say one other thing. In terms of liquidity for investors who've already put money into assets, we have a lot of clients when I was at Cushman & Wakefield who are foreign investors that put millions of dollars into US assets and still today have not been able to get liquidity to those assets. And now that you start seeing assets in certain segments of the real estate market, such as office or hospitality, are starting to have a little bit of challenges in terms of their value. These investors want to get out quickly because they don't want to lose the value they've already created. And so by offering them ability, I'm talking about the LP stacks now, offer them ability to tokenize their individual LP interest and then sell it to retail investors, it gives these LPs a way now to exit from the asset without having the permission of the sponsor. So these are, the real life benefits that we're seeing that the customers really appreciate. And so far, we've been able to tokenize about $2.6 billion worth of commercial real estate, mostly in multifamily assets in main locations. But we're starting to expand into office and into hotel and retail because there's a definite need for liquidity in all those aspects. There's also, you look at the areas in terms of EB5s. Lots of EB5 capital has come into the country, and they came in because they want, to have a U.S. citizenship. But that might have happened 5 years ago, and now they have their citizenship, but they still don't have their equity back. And so they need a way to be able to pull their equity out of those investments, and tokenization is another solution for that category as well. Next slide.
Thank you. Thank you. Oh, is there one other slide? Sorry.
Yeah, I just wanted to point out that
keep on track.
There's a strong synergy between digital assets and digital currency. And I think that we're seeing digital currency increasing on alarming rates. You're seeing cryptocurrency is now just top $3 trillion in value. And so we did something that was pretty interesting. We asked two of our sponsors to allow us to accept Dogecoin in lieu of equity. Now, people say, well, why would sponsors want Dogecoin? But it really wasn't about the sponsors taking Dogecoin. The sponsors will use Dogecoin as a tool for them to get into the asset, but it can easily be converted to USD. So, but the key here is that there's a lot of demand for people who hold cryptocurrency right now who would like to convert that very easily into digital assets. So it's much easier to go digital to digital than it is to go digital to analog back to digital. And so we are focusing on how we can provide more accessibility to digital real estate to the cryptocurrency holders worldwide.
Okay, well, thank you. I mean, we could go on and on. I got to keep us on track a little bit. There's a lot of good questions coming in the chat room, and we're going to revert those back to the end because I think each of those questions would be a 5-minute answer. So real quickly, we're going to bring on Janine in like 5 minutes. But what kind of government regulation is there now around this, around what you're doing? The tokenization of it.
Well, as was mentioned earlier, I mean, the regulations for 506C is pretty straightforward. You have to be accredited investor in the United States, but you also have the 506C Reg S, which
is the same. Okay. Okay.
You hear me?
Yeah. And then when people tokenize, are there other risks that they're taking on, maybe non-real estate risk that they wouldn't take on with conventional financing or fundraising?
Are you asking me or are you asking?
I'm asking you.
Yeah. I don't see any risk they're taking on. I think that there's always a risk in terms of when you're selling to investors, LP investors, that there's a risk that LP investors could, file a lawsuit and be unsatisfied with something going on. But in terms of issuing security tokens to accredited investors, they are invested, they're KYC'd, so there's no really fear of having someone else that you don't know join your capital stack. I think that's the innate fear that a property owner has, is that they typically know who's coming into their capital stack. But when you tokenize an asset and make it available for anyone in the world to buy, you wonder if these people are unscrupulous or not. But because we go through a very strict KYC process, as well as making sure they're accredited investors, that reduces that risk substantially.
There's still LPs with no voting power and stuff, right?
Well, voting power depends on how you set it up. I mean, if we like to take the structure that originally exists with an organization, with a property. So you look at their shareholder agreement, you look at their articles of incorporation, and try to mimic the exact same terms for those shareholders. But there are some times where the sponsor might want to make limit some of the rights that the shareholders might have, but it's different for every kind of client.
Yeah. Okay. Okay. Well, we'll come back to some of these other questions in a few minutes. Do we have, is Janine on yet?
Janine is on.
Hello, Janine. How are you?
Hi, Murray. How are you?
Good. Thank you for joining us.
Of course. It's great to be here.
Please get away.
Sure. So guys, it's a pleasure to be here talking to the ULI. I've been in real estate for a really long time, and I was actually thinking back, I've been to a bunch of ULI meetings, but I don't think I've ever had the privilege of being asked to speak at one. And now all of a sudden that I don't work in real estate anymore, all of a sudden you guys want to hear what I have to say, which is ironic. Today I run a company called Republic Realm. Republic Realm is one of the most active investors in and developers of metaverse real estate. That basically means, at its simplest form, we buy the real estate inside video games that have no stated objective. We pay lots of money for that land and we develop it. We make either games within a game, We develop our own NFT projects, and I'll tell you today a little bit about what that means. And we even build representations of real world businesses inside the metaverse. So for example, we built a shopping mall in one of the main metaverses where we have tenants that pay rent, and we have customers that go and buy things there in this immersive virtual environment. Next slide. So I don't know how familiar the crowd here is today with NFTs. I'm going to assume not very. So NFTs gained a lot of popularity over the last year when Christie's and Sotheby's started auctioning them off. And they are basically pieces of art that are on the blockchain. So the reason why NFTs created so much interest in blockchain technology is because blockchain was this very esoteric idea around software and code, but you couldn't see it. You know, everybody told you it was great and it helped things move around and it was fast and you could move money, but it was kind of imaginary and it wasn't very palpable. And a lot of people kept saying, Bitcoin isn't real and all these tokens aren't real. And then all of a sudden people started slapping pictures of monkeys on them and all different pieces of art. And then you could see them move around and you could have a wallet where you could see these things. And they had this physical representation that was pictographic, and humans love visuals. And suddenly by adding those pictures, suddenly a whole new wave of people started waking up to crypto. They started buying these NFTs, which started as art on the blockchain and then rapidly became about sports on the blockchain and video clips on the blockchain. And today they represent lots of different things. But the NFT movement, we can credit with a lot of the mainstream adoption we've seen of crypto over the last year, and probably a lot of why the crypto markets have increased in value so much. So there was this whole NFT wave. And at the same time, a groundswell of interest around the metaverse. And the metaverse is a concept that's been around for a while. Anybody that has kids on this call probably has children that play in the metaverse all the time. They play games like Minecraft and Roblox and Fortnite. And if you are a little old and were kind of nerdy 20 years ago, you might have played Second Life, which is kind of the first of the metaverses. But today, the reason everybody's getting so pumped about metaverse is it's not just about video games. It's not just about Second Life. It's about the combination of this video game with no stated objective that's built on the blockchain. Now, why do we care if a video game is built on the blockchain? Because the reason why people love the blockchain is because you can move money around. You can move wealth around, and you can do it very seamlessly. It's easier than Venmo to a large extent. So if you put that inside a video game, not only can your kids buy skins in Fortnite, but then they can sell them outside Fortnite easily. And that's what's so seductive. So you go from having video games where people can buy things, but they can only sell them inside that game, to all of a sudden this blockchain paradigm where you can buy things inside a video game and sell them outside of the video game. And suddenly you have people who are willing to spend hundreds of thousands, if not millions of dollars, buying items inside these games, including us. So at Republic Realm, we actually paid the highest price ever for metaverse real estate, which was almost $1 million. And we've spent millions of dollars on this real estate. Each of those real estate parcels inside the video games is an NFT itself. So just like I explained, the art NFTs can be moved around and transferred from wallet to wallet. So too can these parcels of land inside the games. So we do a lot of really cool things at Republic Realm, but a lot of it overlaps with my background. So before I was developing fantasy land and imaginary real estate, I was a real world real estate developer. I was head of real estate development at Standard Hotels. And before that, I was a partner in the private equity firm North Star Capital, which is best known for backing Ian Schrager as he built his entire boutique hotel portfolio. My family is all comprised of architects. My mother is an architect. My grandfather was an architect. And a lot of what I'm doing day to day is surprisingly very similar to what I was doing in a past life. So we hire real world architects. We have mood boards. We sketch buildings. We sketch whatever the project is going to be. And then we use video game developers to build what we're building in code. So they turn those renderings into something that looks like an architectural drawing, but which has no physical constraints, right? The building can literally float in midair. It can be made of anything that we can figure out how to render within the technical constraints of that particular game. And we build it. And when it gets really fun is when we build it and we sell it for lots and lots of money, which we've also done. So we developed spec home development in the metaverse. And I know this is going to start to sound really crazy for you guys. But this past summer in August, we started selling spec homes in the metaverse. And the prices were we listed them for 5 Ethereum each, 5 ETH, which is about $15,000 each, which is a lot of money for a virtual home. We sold them all out in an afternoon. Today, those same virtual homes are selling for $350,000 each. You cannot actually set foot in one. You will never be able to. And that is more than some people spend on their home in the real world. So the reason why I'm underscoring that for you is to share with you, this is not an aberration. This is real. People are spending real money on it, and they're not all people who are insane. In fact, we know some of the identities of the buyers of these homes, and they're very smart people. They're very wealthy individuals who see that the metaverse is going to change how we interact with technology. And that younger generations who grew up playing hours and hours of Minecraft are not going to be satisfied to go buy things from a 2D website alone. They don't want to go to Amazon and surf by themselves. They want to walk into an immersive retail environment and shop with their friends. They want to go to a space where they can talk and see their friends in the closest approximation to 3D that's possible. And that's how they're going to expect to interact with the internet. And that's why big corporations are starting to spend a lot of time figuring out how they can tap into this opportunity before they get left behind. So at Republic Realm, we help companies figure out how to do business in the metaverse. We build buildings for them. We also have built our own brands that are metaverse first. And we've had the privilege of building an entire team of people, many of whom come from the real estate industry. And we are now having them build for us in the metaverse. And it's a really exciting time. You know, a couple of weeks ago, Mark Zuckerberg announced that he was changing the name of Facebook to Meta. So you have big companies deciding to change tax entirely because they realize that this metaverse opportunity is so enormous and cannot be overlooked. And then on the heels of the Facebook announcement, you had Microsoft announcing a metaverse, you have Tinder announcing a metaverse, you have all these different players coming online saying, oh my gosh, this is how the next generation will be interacting with technology. And owning the space inside these immersive environments is how you become the landlord in the virtual world. And that's what we're doing at Republic Realm. I think that's something really interesting for this particular group of people to contemplate today. I don't know what the other slides have on them. Do you want to, is there another slide or is this my last slide? Ready Player One. So kind of the canon of the metaverse is a book called Snow Crash, which started it all and actually coined the phrase metaverse. But the thing that most people are familiar with is the movie Ready Player One, which was an animated movie that has a very dystopian view of what the metaverse might look like. My contention is because it was a book written by a man. And so men like to blow things up and kill things and destroy them. And so their version of what people would do if they're in an environment with no stated objective is to do destructive things. When I think of the metaverse, I think of a place where I can go, I'm going to be a babe in the metaverse and be really skinny and have beautiful clothing and a zillion friends and lots of lavish parties. I'm going to decorate my home to the nines and I'm going to travel. And that's my version of the metaverse. But the beauty of the metaverse and all of the different players that are coming out of the woodworks building them is that there's going to be something for everybody, where we can sort by geography. I've heard about Bollywood themed metaverses specifically for the South Asian population. There are metaverses that are about decorating your house. There are metaverses about outer space. In fact, I just saw a deal memo the other day for a metaverse that's about sharks, where you can pretend to be a shark and you can live under the sea and this will appeal to the men again, where you can eat other sharks and eat lots of other fish. So the possibilities are endless. And at Republic Realm, we try to track every metaverse company we can find. As of, I think earlier this week, we were tracking about 190 different metaverses that are at various different stages, from concept to pre-launch development, and a very few of which have actually launched already. We're investors in 19 different platforms today. And we're excited to keep expanding and seeing what's next, because I think the possibilities are really, really exciting.
Well, Janine, thank you. That's beyond fascinating. I mean, that was a great explanation of it too, because I sort of thought I knew sort of what it was about. But it reminds me, like years ago at the Museum of Modern Art, there was this sculpture, and it was basically like a Lego and a Lincoln Log and a Tinker Toy all attached together. And their whole concept was, you don't have to be locked into these try and combine all these worlds together. So it sounds, when you talk about buying something on, World of Warcraft and then selling it somewhere else, that puts it all together perfectly. So
if you want to sound really smart when you talk to your friends who are in crypto, the holy grail in this space is called interoperability. And that's that thing you're talking about now, where you can use the Lincoln log with your Legos, or you can move your World of Warcraft to your Fortnite.
Yeah.
And that is what we're moving toward. It doesn't really exist yet, but that is the ultimate goal of integrating blockchain into all of these things. So not only can you move your money around or your art, but you can move your swords and your spaceships and all these things that you've accumulated in different games, which, if you believe in the future that Ready Player One outlined, you're going to need them. You might be in space one day and swimming with sharks the next. So you need a wetsuit and a spacesuit and all these different things alongside you.
I can finally sell my old comic books. So no, I mean, that's great. So a real quick question, and then we'll keep moving on. So when the people buy these houses, is it purely a speculative thing, or they've gone up in value, which is great, but why are they buying these houses? Is it part of this, I'm going to live in this metaverse and create an alternate lifestyle, or?
So a couple of reasons. And I think I can answer Brandon Yamada's question with this one. What drives the value of NFTs is three things: innovation, community, and scarcity. So innovation, people want to see it's something different. They don't want to buy the same thing they've seen before. Community, is there a group of people that wants this thing? And is that group bigger than the number of things that exist, right? So how big is the community? Is it growing? Is it excited? Is it going to buy all the product this particular project produces? And then scarcity. So the beauty of the blockchain is that you can keep developers honest. They lay out what the rules of the game are from the beginning, and it's written in a smart contract. So if they tell you there's never going to be more than 100,000 parcels of land, there will never be more than 100,000 parcels of land. And you can actually see exactly how many parcels of land there are and how they've traded. And you can have transparency into the movement of those land parcels. So being able to verify that these things are in fact scarce increases their value, just like why gold is valuable, right, because we perceive there to be a finite amount of it. People are buying these homes because they're scarce. We only made 100 of them. Nobody else is doing it. So they're very innovative. And the community has become very, very robust. So people actually, they've elected a mayor. They've formed their own little government, and they're very active. There's a community that you have to have the key to one of your homes in order to access. It's all online, and it's a lot of fun. People are spending way more time than they probably ought to be if they're employed, talking about what they're going to do in their villa in the virtual world. But people are having a lot of fun doing this. And I think ultimately that's what's driving this movement. It's not just sheer economics. It's the desire to connect, especially at a time when we've all been locked behind closed doors for so long. The ability to connect with people who are doing new, interesting things in a kind of safe space is very appealing.
That is fascinating. So through the smart contract, you create scarcity. I think that answers a fundamental question.
Yes.
So I'd like, in the next couple of minutes, I would like to really invite Yael and Ed and Jake to, join in and, this discussion of the metaverse and any thoughts you have, and, like to hear you all dialogue somewhat. If you have anything you want to share with Janine or build on what Janine has said.
So I'm very excited about the metaverse, and Janine, this was like an amazing and cool presentation, and I loved it. And the sharks themed metaverse reminds me of a Friends episode in which Monica thinks Chan is looking for the sharks. So, but although I might, because I'm not a young professional, young professional anymore, maybe people here don't watch Friends. But anyway, in the metaverse, it's something that we've gotten a lot of requests at SolidBlock actually to build a mirror of a real world asset in the metaverse. So there's also a possibility to tie the two together. And a lot of the sponsors want that. Why do they want that? Do they want their users, their tenants to actually have a space in the metaverse? Possibly, but I think the main reason and one of the really cool opportunities in the metaverse is being able to access users and advertise. So in the metaverse, you have another type of real estate, which is digital estate, and we call it digi estate, where we you know, where if you walk into a shopping mall, you have an unlimited amount of personalized space for advertisement. And, you know, you can also see that in Real Player One, you know, there's advertisement everywhere. So that's another way to kind of maximize value from the metaverse real estate, which again is, of course, scarce because of the smart contract. And another thing I wanted to mention is that in the metaverse, of course, even though you have real world architects involved, you can bend the rules and create really, really interesting things that people can be drawn to, some of which could actually be also replicated in the real world, right? So there are people that are looking for that type of thing where they see something in the metaverse and then they go out and they say, okay, maybe I want that, you know, that house, or I want, you know, that structure. So I think that we're going to be seeing a lot of overlap between the two worlds.
Interesting. Jake, what do you have to add here? This is your sort of zone.
Yeah, no, it's definitely super interesting. But what's also like extremely interesting to me are the types of industries that are trying to get involved in the metaverse and how they're trying to kind of navigate those waters. So for example, you know, like gambling. So there's actually like metaverse casinos where you can like go into the metaverse and like you can go to casinos, like large brands have casinos in the metaverse. Atari has a casino, Bored Ape has a casino. I actually recently spoke to a sports betting company that wants to bring like a sports betting casino into Decentraland. So it's kind of crazy how these like brands are going to try and bridge kind of like the physical and the digital, like similar to kind of like Janine was saying, like you're going to go into Decentraland one day, you're going to put on your, you know, VR headset, you're going to buy a pair of shoes that are going to be an NFT in Decentraland. Your avatar is going to be able to wear them, but you're also going to be shipped the shoe in real life. So you'll have your little avatar will have it, and like you'll like have it as well. So as kind of like the metaverse becomes a thing, a lot of these kind of industries are going to try and like figure out how to do it. Another thing that's super cool is a Shark Tank. So there's like Shark Tank events that go on in Decentraland where, you know, companies, you know, metaverse projects kind of pitch their ideas for funding, right? There's kind of like all these industries that are trying to get involved in the metaverse, and it's going to be super interesting to see kind of like who does it well, who does it wrong, like what brands do really well and what brands kind of just like don't necessarily know how to figure it out. So that's kind of what's like really, really interesting to me here. And then also how kind of, Yael was talking about how kind of like the like digital real estate and the metaverse are going to, you know, combined, right? So it's like, before you buy a house, are you going to force your agent to create a, you know, a physical building in Decentraland where you can see it before you actually buy it, right? So that's kind of what's
so really, I mean, it reminds me somewhat of like, think of the US back in pioneer days. You know, one group of people bought Manhattan Island and to see what they could make of it. And, you know, somebody else bought all the land around the town of Independence up on the way to, you know, Mammoth. And that was going to be the capital of California. And that didn't work out so well. So it's, I mean, you guys are really, you know, you're truly pioneering and creating these things, which I think is great. So we're getting a lot of questions in, which is great. And we could probably go super late, but we won't. We're going to stay on track. So let me get to some of these questions. I'm getting bombarded here, so give me a break. Janine, is the community of houses that you've sold like the movie Inception, where you can bend Paris in half and defy the immutable laws of physics? Is it pure creation? I mean, are there limitations to what you can do in those houses? How does that all work?
We used real world architects, and honestly, I was kind of the evil mastermind behind it. And I thought of all the places that I like. So I made one house that looks like the south of France. I was inspired by Cap Ferrat and the beautiful Provençal mansions there. Another that looks like kind of a Costa Rican sand in your toes surf lodge right on the beach. And the third style of a villa we wanted to make was really weird and futuristic. So we made it entirely of ice. and it's called Frostbitte. So they're all very different and very unique. The first two are actually kind of really like a real world version of a vacation home. And the third one, honestly, could only exist in a video game or some other animated reality. You cannot bend Paris in half, though, unfortunately.
Okay, well, that's good to know. So from Aaron Rash, it's a question I think it is for you and for everybody with their various expertise areas. How do you see hardware limitations impacting the growth of this industry in the next decade? For any and all of you.
I don't think it's a big limitation. I think most of those things can be done on a laptop or on your phone. I think people keep talking about how virtual reality and goggles are going to play a role. And until somebody figures out how to make them look like eyeglasses, I don't think that's actually the case. I think wearing a giant box on your face is not a compromise we're willing to make to interact with other people. It's you're too vulnerable. You can't see what's going on in the world around you. I do think that the environmental impact of all of this is important to consider. Crypto uses a lot of energy, whether you're mining it or when you're moving Ethereum around, it's very energy intensive. And a lot of people point to the fact that the NFT industry is really creating a lot of unnecessary use of electricity around the world. And so I think that's something we're going to need human ingenuity to solve, much more important than the hardware limitations, which in my opinion are not really a big deal at all.
Okay.
Yeah, and then let me just add on to that. So kind of like I was saying before, I think a big limitation is going to be the onboarding process as well. So like until kind of like getting into Decentraland or these metaverses as easy as like, opening up a, window on your computer to the internet. I think it's going to take some time, as well as kind of Janine was saying, kind of just like the internet processing power. Like I can't really run Decentraland on my computer. It's like an internet, it's an internet-based application, and it's just too big for it to run smoothly. So until like technology kind of, catches up to what we're trying to do here, I think that's kind of like the biggest hardware issue.
So then how do you run it? Do you have is it like a special like game box, or how do you access it?
I mean, it's just a website. So it's like a browser-based game. You kind of log into your MetaMask, or, you log into your Ethereum wallet, and then your character is tied to that wallet.
Okay.
Yeah.
So this is for Ed and Yael, kind of early days here, but, a lot of the large investors, think CalPERS, CalSTRS. I mean, they're very environmentally sensitive. Like they're not going to invest in any green buildings that aren't, at least LEED gold, right? So if say you're a LEED building and all of a sudden you're financing with a lot of, a good amount of Ethereum, which is considered not eco-friendly. I mean, do you run the risk of other investors institutional investors not being able to, or not wanting to invest in it? I mean, have you had those discussions with people, Ed or Yael, or how do you think about that?
I haven't had that discussion with any of our investors. I think most people are really looking at the equity side of it, so how much capital they can generate. The big institutions are looking at it from a liquidity standpoint and the benefits they have. I think might be some considerations about environmental. I just don't think that's the top of their list right now, but I might be wrong.
So I want to kind of address the difference between a blockchain transaction and a crypto transaction. So it's something that we kind of didn't really mention throughout our presentations, but for example, the Aspen coin, all the initial investment was all made in fiat, which is US dollars, right? And then Ed mentioned Dogecoin, for example, that they accept Dogecoin for investing in real estate, and we at SolidBlock accept, by virtue of partnering with exchanges that accept a lot of different cryptocurrencies, we can accept a lot of different cryptocurrencies for the asset, and they will be converted into US dollars for the sponsors. The sponsors most of the sponsors at this time don't want to hold crypto, so they will be exchanged, right, for fiat currency. And that's what the sponsor will get through the exchange partnerships that we have. So the crypto transactions are the ones that generate the most wasteful, energy by design, right? It's actually by design, especially in Bitcoin. It's known for wasting a lot of electricity because of that. That's the way Bitcoin is mined. You know, as Janine said, through human ingenuity, we're going to overcome. And just like in the early days of the internet was very wasteful. It took killing, you know, hundreds of thousands of trees to sell one book on Amazon, right? In the 90s or early 2000s. So Bitcoin and other crypto is becoming more green. Now, we at SolidBlock have a lot of ESG projects, environmental, social governance. So these are, you know, green, sustainable, and so on. So does accepting crypto cancel out the benefits that we're giving? You know, the question lies in how many transactions do you actually run, right? So if somebody has crypto already and they're sending it to us, you know, to cash out, to buy a real estate asset, and most likely it's probably not a huge impact because that crypto has already been generated. Whether or not we perpetuate creation of more crypto by accepting crypto, that's a very philosophical question. But in terms of blockchain, in terms of using the Ethereum ledger or other ledgers out there to facilitate liquidity, that process by itself is not necessarily unsustainable, right? A lot of the data transfer and a lot of the things in our process happen off chain. We use basically that means that, you know, like storing data and other things does not require actually Ethereum process and exchange of Ethereum. But the important thing is the transaction. Like when I sell my security to someone else, that, you know, and so my name is no longer written as the owner of that security, and someone else's name, or, you know, this encrypted number is written. That specific transaction, you know, that specific transaction does not generate a huge amount of waste. And actually, new blockchains are coming out all the time that address this. So using blockchain is not the same as a crypto transaction.
Okay, thank you. That's very helpful for someone like me who's still a neophyte. So there's a question from earlier on, which I think is important, and I mean, Yael, and that it would towards you. When you raise capital for tokenization through tokens, is there something recorded on title? Like, are you like, is there something in the county recorder's office that records that there's X amount of these things on title, or is it more like a UCC, like a preferred equity deal?
Well, in our case, the properties are usually recorded on title initially, and then when you're tokenizing the equity, you're actually putting that on the blockchain. But the original title of the property is recorded in the local jurisdiction.
Okay, but the tokenization isn't on there isn't recorded as like a lien on the property on title, is it?
No.
There is a model where that could be used actually, and we have one use case where we actually tokenizing through lien, and that's usually done for a single family home deals, right? You can actually, and that's going to be used a lot in DeFi. We didn't talk much about DeFi, unfortunately, maybe on the next meeting. It's also another exciting blockchain / real estate opportunity. But actually, in terms of the title, most of the transactions we make have to deal with just, you know, LLC companies, holding companies holding the title, right? So usually what happens is in the process, we didn't talk about the process too much, but in the process of tokenization, you create a special purpose vehicle that will then, after the investment goes through, will then gain the ownership of either the title, like Ed said, then you change, you know, the title under the ownership of that SPV, or it will gain the ownership of another holding company that holds the title. And that makes things a lot easier. The transaction will go a lot quicker because it's a more of a corporate transaction. And with large commercial assets, that's something that we see most of the time. With smaller, there's some other companies that tokenize like single family homes, like Realty, and they probably see a lot of title transfers in this transaction.
Okay, thank you. That's helpful. So we got a couple minutes left, and I want to just ask each of you the same question, and we'll start with Janine. You got a bunch of young real estate professionals online here. They're loaded for bear. They're ready to go. What is some advice you can give them for how to maximize their opportunities within this sort of amazing new worlds out there? Janine?
My best advice for people that are looking to dip their toe in the water is buy an NFT and join the Discord channel for it. That's your best way to get your feet wet. You might even luck into getting one that appreciates massively and make a bit of money and get hooked, but you'll join the community. You'll meet lots of interesting people from all around the world. And it's an easy way to get involved and also have a lot of fun while you're doing it.
Yeah, thank you. Ed?
Yeah, I think that the best way to learn is to participate. And I think that you can, because, first of all, cryptocurrency is not that expensive. Shares of digital real estate is not that expensive. We have allocations as low as $1,000. So I think that if you get in and you purchase, you now will be paying more attention to what you own. But I think there's a lot of opportunities. Blockchain has created a lot of cracks in our ecosystem, our traditional ecosystem. And I think there's a lot of opportunities for younger folks to get involved in terms of every aspect of when you talk about real estate. There's still appraisal that's necessary. There's still referrals of deals. There's still deal flow. And not much has changed in the way we do business in terms of real estate. Blockchain just adds value to the whole process. So I think that people who are interested in this space should just start buying some cryptocurrency, buying some digital asset, buy some properties in the metaverse if they can, and really start getting involved and seeing what some opportunities are. Metaverse, designing architects, as you said, there's opportunities there. In digital real estate, brokers, we're talking to brokers because they see some of their income being challenged with all this emerging technology, but brokers can actually have a lot of expertise in terms of value in real estate. And so, that's very important for this whole process. So I see a lot of opportunities for young to get involved. And I just think it's a matter of leaning in.
Lean in, for sure. Yael, what do you think?
I think that the imagination can run wild on the new types of products that we can see. But also I think that we're going to see, with every passing month or a year, we're going to see a lot more. And imagine walking into a bank and, with, let's say, $100,000, right? So now what can you do with it? Well, you can put it as a down payment and then get a mortgage, right? And buy a house. You can put it, you can lock it into some sort of an account and start earning interest. You can just put it on your credit card and start making payments. Now, the same thing you're going to see with this digital real estate, right? So you can buy $100,000 worth of security tokens, right? Or NFTs or, whatever. And then you have the same type of services in DeFi, which is mind-boggling, that now you don't have to have a bank to go and get the loan. And you don't have to have a bank to go and get credit or start paying, do payments and other transactions, right? So you can stake your crypto, which basically means put your crypto in a vault and earn interest. You can do the same now with security tokens. You can buy a piece of real estate and then stake it. Now, a few companies are starting to do that, and then get interest. Or you can, you can also. So how do you do that? First of all, there are companies that have like peer-to-peer lending on a decentralized finance, in a DeFi space. Through decentralized or autonomous organizations, right? So, and like MakerDAO, for example. So beyond those, you're gonna see a lot of derivatives like futures and options and indices, stable coins, index coins, you name it, right? So, and imagine what's gonna come out next year. And the final thought that I have is ride the wave, right? So DeFi is all the rage now, NFTs, and metaverse, right? So right now, those are kind of the waves. And then, real estate is notorious for being a dinosaur and just lagging behind in terms of tech. So these are the waves right now. And I'm so happy that we're talking today to people that are kind of, a little younger and are ready to ride the wave. So let's do this. Happy to talk to anybody who's getting involved.
That's great. Thank you. Jake, you got 2 minutes. What advice do you have for your peers?
Yeah, I'll do it quick. I'm essentially just gonna reiterate what Janine said, because that's essentially what I did. I basically found kind of Decentraland and Sandbox. I'm like, oh my God, like I come from real estate background, and I thought kind of virtual real estate was a great way for me to kind of like do something completely different, that my background still gave me kind of what I thought was a leg up. I joined the Decentraland Discord. I just started chatting people up. I met a bunch of people. Like I met people that, you know, essentially like launched their own NFT collections. I bought those NFT collections, and then those gave me access to amazing communities, amazing people. So for example, I have an NFT. It's called Last Slice. I met just someone in the Discord, and he launched that project. It essentially gave me access to a community of like 150, 200 people that are extremely entrenched in the community. So that's kind of how I got into it. Really get into it, you know, like, you know, meet friends, make friends, meet people, and kind of, you know, ride the wave with the peers that you meet along the way, you know, make friends and you know, have fun with them.
And Jake, you've already given people the most important piece of advice, which is don't lose your secret password ever for these things.
Do not give away your seed phrase. Keep it safe.
Seed phrase.
I'm your dad, you know.
Okay. All right. Well, listen. Yeah, this is super, super interesting. And, you know, I forget which one of you referenced the book Snow Crash, but I remember reading it like in the late 80s or early 90s or whenever it was, and just being blown away by the futurism of it, you know. And I think if you go back and read it now, it's maybe a little dinosaur-y, but it was so ahead of its time. And if people want to go back to like source documents, like they say in history class, go ahead and read it. So we got Yael, you're up really early. Janine, you're up really late. All the rest of us, you know, it's time to go hit the pub or watch TV or something. So thank you all for your time and your effort. I know the YLG group who put this on put a ton of effort into it, and we're all very appreciative. And I hope you all can stay in touch. You have our panelists' contact info and or whatever. You have their names. You can find them on LinkedIn, and I think it's just great information. So thank you, everybody. Chandler, anything before we sign everybody off?
No, I think we're good to go. Again, thank you so much to the panelists and the sacrifices of an early morning or late night. This was amazing, and I think we all discovered how much more there is to talk about here. So we'll figure out the follow-up, but thank you all for joining.
Okay. Good night, everybody. Thank you.
Thank you, everyone.
Thank you.
Thank you.